All right, so today's lesson, we're going to be talking about level 1 understanding of market psychology. Now, there's a lot of different things out there in regards to market psychology, a lot of different books written on this. So we are not going to be talking about the traditional market psychology. We're going to be going into a niche of trading psychology, really, that I feel like this is something that I've pioneered. The other stuff that I teach as far as the 3 market phases, things like that, that's my interpretation of long introduced concepts by Richard Wyckoff and different people since him. Those old guys, they all invented the accumulation, distribution theories, all that. And so the master pattern is really just my interpretation of that. But as far as what I'm going to talk about today, this is something that I feel like I've never heard anyone put it this way, as far as this little niche of market psychology. So we're going to be talking about the introduction to pain and pleasure theory. And in reality, it has a lot to do with market psychology, but it's really the essence of why traders lose. A quick story before we get started. This was probably 2011-ish. I was trading a 2-minute chart into a 15-minute chart into a 1-hour chart, which is what I got introduced to when I pretty much got serious and started doing this a lot. I was trading the New York session, and it was probably a big news day because we chased after big news days back then. So anyway, I was trading a low time frame. You can only imagine how it worked out most of the time. So I was sitting there, and it was, we got up at 4 a.m. News came out at like 5:30, and then traded through that. And I was sitting there at like 10 a.m. I remember I had, I want to say, over 30 closed positions at the end of that morning. Again, trading on a 2-minute chart, so there seemed to be a lot of opportunity, a lot of movement, and I was shooting at everything. I was sitting there and had done over 30 trades, and I looked back at all of them. I think it was, I can't remember the exact number, but I want to say like 27 of them were negative. Not huge negatives, but slightly negative. And I ended up being down like 40-some pips or something because we were only going after small trades or whatever. And I was sitting there dumbfounded because I'm like, this market literally moves up and down 50% of the time. It's going up, 50% of the time it's going down. Like, it just goes up and down. How can I have such a huge loss rate over the course of this session when it should be almost even? I should at least be at break even. And so why is this happening? And that question from that day led to, honestly, that was kind of where I started exploring alternative methodologies and different things. Because that day, I remember specifically, I had, I think it was like a 10-period moving average on my screen. I had the super trend indicator or a rendition of that. That was one of the indicators we got introduced to, which is a trend following indicator. So I had these things that I was essentially trying to buy and sell as it came across these things. I was doing much more traditionally taught methods because I thought that's what everyone does. I didn't know any better. But after that, I looked at it, I'm like, how is this even possible that someone could be down this much in such a short amount of time? How could I not at least have half of these positive? And it really came down to what led to the study of this theory that I came up with, which is pain and pleasure. It's how can I lose? How can I be a better loser than winner in a market that is essentially 50-50 most of the time? How is this possible? So I want to tell you that story because that day specifically led to almost everything. It led to the discovery of all the alternative trading methods as far as like the 3 market phases, accumulation, distribution. I thought this isn't the way. And I feel like I think I'm a pretty smart person. I'm not the smartest, but I know a little bit about the things that I study deep about. I'm like, I feel like I should be able to figure this out. When I started looking at these alternative methods, everything kind of started to click. But the psychology side, with what I discovered there, which was really putting a framework, I thought, if I can have such a huge loss rate, if I can figure out why traders lose, why this happens to me, because it wouldn't just happen to me. I would see it happen to other people too that I was around at that time too. It wasn't just me. Like, this is a phenomenon here. If I can figure out the mechanics of why this is happening, why it's so easy to book losses, and then I can reverse engineer that to do the opposite, then you should have a pretty amazing win rate. And therefore, that's what's grown into our basic master pattern strategy. All these things together have come up with what we have now in ATS. But the study of what we're going to talk about today, the pain and pleasure theory, that's really what ATS is designed around, the software side, the methodology. It's designed around, if we understand why traders lose, we understand what decisions they're making, we try to do the opposite, we should come out ahead. That's essentially what it is we're trying to do here. So anyway, that's my story and my really way too long lead into this lesson. So let's get into the next part here. So what is pain and pleasure theory? This is the most important concept you will learn throughout this training. I really think it is. Out of everything that I personally teach, if you get your head around this one thing, you will immediately start to look at the market differently. And it will lead you to, like, if you didn't know anything about ATS or master pattern, anything, you just looked at it from this point of view, you would eventually end up with something, especially if you're creating indicators in software, you would end up with something like what I've created with ATS. That's what ultimately this understanding leads into. So pain and pleasure theory is a concept developed by Trade ATS, me more specifically, that describes why most traders lose their money and the process in which it happens, which is the more important part. So why is pain and pleasure theory important? By understanding why and how 95% of traders lose, you also define the exact strategy needed to become profitable by doing the opposite. So I think we've covered that pretty good. So let's talk about pain. When you accidentally touch something hot, what is your first reaction? Most people will immediately withdraw their hand to make the pain stop. The key thing in understanding this is that it's a natural response. It's something that from the moment that we're born, nobody needs to teach us to try to get away from pain or avoid pain in all its forms. Psychological, and that's really the biggest thing here. This is, in trading, it's psychological pain, but physical pain, everything we do in life is try to avoid pain and go towards pleasure, what feels good. We want to feel good, don't want to feel bad. So this is something, again, that is not, no one needed to teach us these things. They are completely natural and wired within us. Whereas pleasure, when something or someone makes you feel good, when do you want it to actually stop? When have you been, like in our illustration here, you got this woman getting a massage. If you ever get a massage, especially if your muscle's hurting, you're like, that, especially the last 10 minutes, you're like, if you get an hour massage every time, we have a massage therapist that comes to our house once a week. It's always that last 10 minutes. I feel like it comes together. It's like, I wish, now I'd like to go for maybe another 20 minutes. But the point is, like, when something feels good and it's making you either psychologically happy or physically happy, there's not a point where you're like, yeah, I've had enough. Like, let's go back. I need a little more pain in my life. Like, if it genuinely is making you happy or making you feel good, you want it to keep going. So, yeah, the answer to that, never. They will take no action to make it stop if they can help it. So, this is the natural way people operate. Okay? They want to go away from pain and towards pleasure. Okay? So, we're going to look at how this translates into the market. Next part of the slide, I've already kind of covered this. Again, the responses to pain and pleasure are natural. No one needed to teach you these responses. These same responses are directly responsible for all your losses in trading. So now we're going to see, again, how does this translate into trading? So I'm going to go through kind of the same sequence here. Losses equal pain, psychological pain, more importantly. Sometimes the losses are bad. Sometimes psychologically, we can actually feel so bad that we do feel it in our body. Stress, it collects in our shoulders. It can make your chest feel tight. But either way, that psychological pain, when you see that you're losing money, you have the same natural reaction to end the pain. And how do we do that in trading? If we're seeing a loss on the screen, we're feeling that loss, we close it. So we don't see it anymore. We want to remove it from our awareness. Or we don't want it. We're also scared that it's going to get worse. And if it gets worse, what does that equal? It means even more increased pain, right? So pain demands immediate action. Something's on fire, you got to put it out. You got to dump a bucket of water over it, right? If you know something, some doom is impending, you're going to want to take the steps to stop that thing. And in trading, it's that action. When we take action, we push the button, for better or worse, our results get sealed in. That's where we get our outcome for profit or for loss, which is what we're dealing with in trading, right? So that's the thing I want you to take away from. Pain demands action, and action is what locks in your results. Now we're going to move over to the other side of the spectrum. Gains equal pleasurable feelings. Who doesn't like waking up to a trade you were holding overnight and seeing that you're up 50 or 100 pips? It's wonderful, right? You're totally natural for feeling that. You should. But the problem is that when do we want that to end? Well, when you're in profit, you have the same pleasure reaction to not do anything, and we want it to keep going. Pleasure discourages action. So profits on paper are not realized gains. So sum this up. Natural reactions to pain and pleasure are what causes a trader to be a natural-born loser without any knowledge or study. The markets are going sideways most of the time. And we talked about this on the last webinar if you guys were there. But we talked about that the trend phase of the market is one of 3 market phases. We have 3 market phases. 2 of the market phases, the first 2, are contraction and expansion. What is the characteristics of those phases? A lot of people will call it small range and big range, right? Contraction is a tightening of price, and expansion is a widening of that price. So as we go through this area of the market, you're going to get a lot of action like this, whippy sideways action, okay? That's the majority of what you're going to experience. So when we combine that price action with this internal situation that we're facing, meaning losses equal pain, gains equal pleasure, every time that you guys get into the money, a lot of times it's going to take you out of the money just as fast. And when you're feeling the pleasurable feelings of seeing a profit, you are not looking to stop that naturally. Therefore, just as fast as you got into the profit, you can be taken out of the profit most times. And now the problem is, now when you're out of profit, you're now experiencing pain, which demands decisive action, fast, end the pain. And that is in the form of hitting the button to close. So going back to my original story, that is what I realized. Why am I closing so many losing trades? 27 trades out of 30-something. How is that possible? And it's because the market ultimately was ranging that day. Even though it was a news day, it still ended up ranging most of the time. So I would see a lot of 2, 3, 4, 5 pip profits, and then it would whip out, and then I would go down 2, 3, -4 and close it and say, oh no, it's going the other way. Then I'd get in the other way and then sell the market or whatever, vice versa. And same thing, it kept getting in a little bit of profit and it would take me out. And I was like, why am I closing these? I'm closing them because they're uncomfortable. And I'm actually pushing the button, getting in the market. That's not hard. But when you close is when you seal in the results. And I'm closing these at a loss over and over and over again. And it's literally because of this pain response. And there's other things that we'll get into in a minute that amplify the pain other than just a price action. So, but this is super, super important to study this, because if you understand that every single trader out there is subject to these natural feelings, then you understand what's really driving them. Because a lot of people will say, well, the markets are driven by fear and greed. I think that those are a different derivative. I think that's true. But I think that this, what we're talking about here, the pain and pleasure, is really at the core of what drives action. Fear is associated with pain, and greed is associated with pleasure. Because everyone they want to make money because it makes them feel good, right? And fear is associated with pain as well. So those are just again, I think they're derivatives of what the core root problem is. At the end of the day, it's these natural feelings. And if you realize that everybody else out there is subject to these exact same feelings, you understand how they tick. You understand when they're feeling pressured to close a trade. And then when we combine that with the master pattern methodology, understanding liquidity, which is very important for a repeatable trading strategy, you need to understand where's the discount liquidity, how's it going to be accumulated, and how's it going to be liquidated for profit. When you understand that, then you understand why the banks do what they do, why they want to push people into their pain zone, because it's very, very predictable liquidity for them, which they count on to make a profit. They can't do what they do without it. So they're the ones that know about this more than anyone. The only way to get predictable liquidity to come into the market is to get a predictable response from the participants in the market. And nothing's more predictable than hurting someone and getting them to react. All right. So right here we could see that we have an example of the chart. The S in the red circle stands for traders selling. We can see that the market's starting to head down. And breakout traders especially, they're looking, okay, it's starting to go down. I'm going to sell. The red line above represents their pain point. This is where they start to feel uncomfortable, which is essentially when they're out of the money, right? We can liken this to a stop loss level. But this is also something I'm going to say right now as well. It does not matter whether they have a stop loss or not. Some traders think, well, the way I'm going to psych out the banks or I'm going to get around their tactics is I'm not going to run a stop. It does not matter. If you are in at this level, if you sold at this level and the price is now at this level higher, I don't care if you have a stop loss or not, you're feeling uncomfortable and you're going to be likely to click the button yourself. So whether you have a stop there or not, doesn't really matter. Okay. So keep that in mind. I've always got astounded that people would tell me, like, I just don't trade with stops. So the bank doesn't care. They know where you're getting in. And also, too, likely your behavior, if you're following traditional methods of trading, likely your analysis is coming to the same conclusion that most of the other retail traders are coming to. They know where you're getting in, and they know that their stops is probably your stop too. Whether your stop is actually there pending is irrelevant. So keep that in mind. Okay, so the P at the bottom represents your pleasure point. So if you sold, now price is at the bottom, you're feeling really good. The problem, like we've been talking about here, is that no one's incentivized to end pleasure. We should be incentivized to take profits, but it's very difficult to do, especially when you see an aggressive move like this. You're like, man, I wonder how far is this really going to go? But what we know about the market phases that we need to stay connected to is that it's sideways most of the time. What does that mean? It means you get stuff like this. Here it comes back up. As fast as it puts you into the profit, or almost just as fast, it takes you out of the profit. So what ends up happening, you end up closing with a small profit, a break even, or a loss. That's a reality. So what you saw on paper is not what you took home. And it's because of that lax state that you get into because you're happy that you're in a winning trade. These are things you got to stay real vigilant to. So let's keep going. Here's another one. As the market goes, now you think, okay, it's going up, so I'm going to buy. I got stopped out. Let me immediately reverse my position, right? This is total standard behavior for a lot of traders because also they're not trading in directional bias either, right? So this is how you really get yourself crossed up. They jump in, go the other way. Now they're in pleasure again. They're like, okay, this one's it. This is it. They're holding. The buy is where they got in. The new red line is where, just right below that, that's where they're going to start to feel uncomfortable. And then the P is where they're feeling really good. Max pleasure chemicals flowing, right? What happens? Market ranges, 90% of the time in the contraction expansion phase, we're still in that overall, probably on the higher time frames, right? So comes down, stops them out. Another break even or small loss, even though they saw a nice profit on paper. They buy again. They're in max pleasure. What happens? Market's still ranging. They come down. They don't book it. Now they reverse. They sell. Stop loss goes above the high. They're going to give it a little more room. What happens? Now the market's even consolidating harder. It just keeps hitting that pain threshold. Okay. They sell again. Another profits on paper. Market's still ranging. Comes back. Stops them out. So you guys get the point now. This is the reality of most of the market environments that you're dealing with. Most of the time. And markets will break out and have great trends. They will, but that's not the rule. Your guys' strategy, trading the master pattern, trading the basic methodology, which is essentially grounding yourself to a directional bias, and then depending on that directional bias, if it's up, you want to trade undervalued on your lower time frame. If it's trading down, you want to trade above value. The reason that you're doing that is because it allows you to survive markets like this. You may not be knocking it out of the park, but you can still get base hits and live through these choppy markets, which is a lot more than most people can say. You are by default using this to your advantage from the get-go and not chasing the market like everyone else and being subject to these things. So you combine the master pattern methodology with the knowledge of how this is how it's working in the background. That is the keys to unlocking what starts to be a good, profitable way to interact with the market. That's where it starts. Can you get better at it? Yeah. Will you misjudge it sometimes? Yeah, absolutely. But if you don't even understand this at all, you could imagine how lost most retail traders truly are. They think that they are one indicator setting away from cracking Forex, from having a money printing machine that they can turn into a robot. That's what they're thinking. They're going to spend years doing that. When at the end of the day, it's a study of liquidity and what causes liquidity in the market. It's the only thing that matters. So you start from that point and then build your methodology. Build your methodology around how others are in pain, how that liquidity is going to be released into the market, and then use that to interact with the market yourself. So let's keep going. So what about pain intensity? That's another important part here. Your pain threshold is directly related to the amount of risk you're taking. The more risk, the closer the pain threshold. So now we're going to talk a moment about trade size. You guys in this room, again, I know you guys have heard me say this a lot, but this is for you guys watching these lessons that haven't heard this. Trade size. If you are doing what most retail traders do, you want to make as much money as fast as possible. So what does that mean? It means short-term trading and leveraging as much as you can on every single opportunity so that you can have astronomical gains from the get-go and compound your account 100% a day. Sounds like a great story. We all want that, believe me. But is it reasonable long-term? The stats would say no. Are there a couple unicorns out there? Yeah, but we're not trying to make unicorns here at ATS. We're trying to get the majority through so that you can have some stable income over a course of time that will be meaningful for your life. Are we trying to make billionaires here? Going to be the next Steve Cohen or Ray Dalio or any of these big guys? No. We're trying to make a meaningful withdrawal for your life long term and end the swings. So the amount of risk that you take is going to have a direct impact on how you can trade within this methodology, how you can survive these sideways markets, which is mostly what it's about. By default, you'll end up in some good trending moves, but it's about surviving until then. It's about not blowing through several accounts before the market opens up. Let's go to the next one. So what's secure? Here's some suggestions. Use wider stop losses, placed well outside localized master pattern framework and cycles. Remember that all high and low points within a defined expansion range can and usually will be used by the banks for the accumulation of supply. Don't be their supply. Trade with multiple smaller positions instead of going all in at once. The banks accumulate over a range of prices. You should too. So the cure to this, ultimately, what we're saying here is giving yourself room for the market to do what it needs to do, and trading smaller, and then being able to add to your positions over time. That's the key. And a lot of traders struggle with this because they think that trading smaller means that their progress is going to be slower. And it's the opposite way. By trading big, your pain threshold, the room that you have to weather pain, because we're all going to experience pain. It's another important point. You can't get rid of this. In fact, let's back up just a quick moment. This is something I should have said earlier. A lot of people think that your system has to be so mechanical so that you can eliminate emotion. This is stupid. You're never going to eliminate emotion. And you're never going to have a system that is so mechanical that you could just press a button. If you did, you would have a robot doing it. It is always going to have some level of judgment needed on every entry. You can have a lot of best practices. That's what we'll talk about them at ATS. We have general rules like trade and trend, start from an overvalued or undervalued position when you enter the market. There's some basic best practices. Don't trade out a session. But as far as the hard defined rules, what's the exact stop I should have? What's the exact limit? What's all these little mechanical things? You're never going to get a set of a formula that is going to adapt to all markets. The only thing that adapts to all markets is understanding the market phases. And those phases take on different times. They have different time that they take to play out. They have different range sizes. All those things have to be adapted to in the moment. And you have to adjust your position sizing, all those things. So you're never going to have a situation where it's so mechanical that you can eliminate all of your emotion. It's just not going to happen. So that's okay. The way that we're going to deal with emotion, our own pain threshold, is we're not going to try to get close to it. You're going to get in a bunch of trades, even using the master pattern strategy, that are going to take you out of the money. It's a fact. Nobody's that perfect. We're not trying to call the tops and bottoms. We're just trying to get entry in zones where price is typically overvalued or undervalued. That's it. It's the best you could do. It's great. It's a great place to start. But the market can still range out. It could still mess with you at those levels. We need to prepare for that. So how are we going to prepare for that? We do it with smaller positions, less expectation. We want our pain threshold as far away, especially in the beginning when we first start working a trade idea. We want it far away so that we can survive the unpredictable. There's so many things that are unpredictable in the markets. We can't account for all of them. We have to have a survival plan. And then you add to those positions as things start to shape up, because you will get more clues as things go. Sometimes you won't be able to add to them. And some people have that fear. They're like, well, what if I can't get in my full position? What if I just trade it with 1/5 or 1/3? That may happen sometimes. But by trading a smaller position, you'll realize that it's so much easier to see profits multiple times on a trade. Even if you put in a trade anytime, regardless of the trend, you take a small position, a 10-cent pip, or depending on your account size. Let's say if you have $10,000 in an account and you trade a $1 pip, it's all pretty meaningless according to that account size, right? You trade a $1 pip and you just buy or sell. Almost in any market condition, you will notice that $1 pip will put you in the money and out of the money several times because the markets are ranging. That means you'll have several opportunities to just close when you see a profit. Okay, so that's the reality of what's going on here. So what we're trying to figure out when it comes to position sizing is we're trying to find a happy medium between giving us a lot of room to absorb some pain, but still be borderline being meaningful enough that we can make a reasonable amount of gains. There's a sweet spot in there that is going to be unique for everyone, but I would default to, if you're coming out of the retail trading space, which I'm assuming most everyone that's going to be watching these videos is you're going to have to tune it down. You're going to have to fight with the constant feeling that you need to up your lot size. If you the smaller you go, the more consistent you're going to end up being, and you can always add. Once you're all in, then you're all in. You can always add, and usually there's multiple opportunities to add to your trade. So start small. You maintain your creativity. You keep your pain threshold far away. And most of those trades, just like I said, almost if you bought and sold at any level, you'll have plenty of opportunities to close in profit. Whereas the opposite of that, if you trade too big, your pain threshold gets close. You'll notice that in how tight you make your stop. Your stop's going to be really, really tight because you're trading too big, and it's going to get hit all the time. It's death by 1,000 cuts, and it's very demoralizing. So that's really what you need to work on here, in my opinion, is to work with these concepts and adjust your position sizing and the things you do to make sure that you can weather the storm, because most people aren't. And that's why they're blown through accounts. That's why they're having emotional swings and equity swings like crazy. It's because they're unwilling to do this. If you start and you are willing to do this from the get-go, you're automatically going to be in the top percentage of traders, because you may hear some fish stories of other retail traders. I tripled my account in the last week or the last month or whatever. I don't care. Show me that 10 years from now. They can't, because they will eventually go through a series of losses that are catastrophic. What I'm talking about right now is a strategy for your next 10 years of your life. That's what we're talking about here. It's something that is not going to be extremely fun or exciting, but it's something that you can look back on 5-10 years from now and say, I genuinely made progress. That's the difference here. It's a very stable platform by putting these things into practice. And the last thing I'm going to say on that briefly is that if we reverse engineer what Wall Street does, everything that they do is so that they can take less risk and make more money. How are they doing that? They're raising capital. Why? If they have the best traders in the world that can have the best technology at their disposal, they have rooms full of analysts that are ready to present them with opportunities, doing all the legwork. They have all these resources. Why are they raising money? Shouldn't they be able to compound their accounts every day? And why haven't they been able to do that? Why do they work their business model the same way as they do? It's because the more money they raise, and this is for the more proprietary trading and hedge fund side, right? This is not market making. That's a different business, and brokerages. We're talking about active trading. They're raising money for their funds. Why? Because they get not only performance fees, they usually get 20%, at least in the hedge fund space, they get 20% of the gains they make on the overall fund. Plus they get a management fee right off the top. Just basic income and expense. Okay? So the more they raise, the more money, capital they raise, the less risk they have to take to make their own salaries. The hedge fund manager is making $100 million a year, but he's running a book of $100 billion, or $50 billion, or whatever it is. It's all relative. He's totally happy making his $10 million, $20 million a year, whatever it ends up being relative. Totally happy. The last thing that the hedge fund guy wants to do is mess that up. How is he going to mess it up? By taking too much risk and scaring off his investors. Those guys that invest in those funds do not want to see a 20% swing in a day. They will freak out. They'll like it if it's up, but if it's on the downside, nobody likes it. Even if they made a bunch of profit up until then, they don't like that at all. So the hedge fund guys, the way they exist, raise more money, take less risk. Make lots of, ideally, hopefully they can make performance gains, but make lots of basic management fees as well. Get our salaries paid. Pay our traders basic salaries. Everyone gets to go out to, where they go to St. Bart's and all those islands on the weekend. They get to live fabulous lives existing, okay? What's the equivalent of that as a retail trader? Well, the best invention, I've said this many times in recent history for retail traders, is prop funding. That's our equivalent. You don't have to go out and start a hedge fund. You can raise assets under management and get even multiple prop accounts that you're managing that gives you the same type of environment to exist. You want to raise your income by raising money. Don't do the normal retail trader mentality by taking your last $1,000, putting it in an account, and then leveraging the crap out of it because you need the money to grow so fast. That is not what Wall Street does. They're the ones that own this game. We don't. They do. It's their game. It's their business. We have to figure out a way to mirror everything that they do and create our own personal business in that thread. So understanding how liquidity is created through pain and pleasure, most pain, ideally. That's how they manufacture liquidity. They understand the pain points. That's what ATS software is all about. Liquidity lines, institutional levels, all those things, all based on pain points. Okay? We understand the overall flow of money just based on the time frame direction, the higher time frame direction. Okay? We exist in the market by trading smaller lot sizes so we don't have huge equity swings. The way you raise your income is you raise more money. You're still trading low lot sizes relative to the big pile of money that you're managing. You see how everything you're mirroring, everything that Wall Street does for your own personal business. That's it. And most retail traders are not willing to do these things because at the end of the day, the way social media makes them feel, everything makes it feel like they're going slower or that they're a loser. 3% a month, 2% a month puts you in the top traders in the world. Maybe not in the moment. Maybe you'll feel like, well, but my friend who's been trading 6 months just made 30% the other day. I don't care. I'm talking about 10-year lifespan, 20-year lifespan, 30-year lifespan in this business. You're 2% a month. You see who's still around. You or the guy doing 20 or 30% swings. Just see. That's the difference. And you can build off of that and get better over time. You can have months where you do maybe make 20%, but that's really going to come down to market environment and the overall macroeconomics. It's about survival. It's about survival. It's about putting up some small repeatable gains that are relatively easy, being disciplined to finding those opportunities and wait for them, and having a really long-term outlook. And if you need more income, raise more money. Don't leverage your account and risk. That's not good for survival. So that's it on that one. I know I went a little deep. I touched on a lot of different things in there, but I feel like it's all relevant to this lesson. Because again, this understanding, the pain and pleasure theory, it really powers everything else that we talk about here. So I feel like this is the most important thing to study to tie into everything else we do. So again, what's the takeaway? Pleasure creates complacency and non-action. Pain creates swift action. Markets range 90% of the time. This means that every buy or sell position you take at any price has a 90% chance of being out of the money in the near future. This means you will experience pain on almost every trade. The intensity of your pain is directly correlated to your trade size, the risk you're taking. Use small positions and wide stops outside localized master pattern framework. When we say localized, just to be clear on that, that's the current expansion and general range you're dealing in. You'll have a range of the swing high, swing low points, and you'll have an expansion line that you're typically dealing with. That's what we say localized. You want to keep your pain threshold outside of those areas, at least to start when you start working an opportunity. You want to keep it wide stops outside the localized master pattern framework so that you don't fall victim to liquidity harvesting by the banks. You want to stay out of their zone because not only do you not want to fall victim to that liquidity harvesting, but you want to see it happen so that you can use it as well. And that really is kind of maybe the big insight here too as well. If you're not seeing liquidity harvesting, is there a trade? If we're following the banks, they have to work it a certain way. They need liquidity to get in, liquidity to get out over a large time horizon. If you're not seeing that happen, is there really a trade for you? Maybe there is sometimes, but just something to think about. We'll just plant that out there. So that's it. That's the lesson for today. And I see some questions that were typed in. Does anyone have any questions that they would like pertaining to this material? Would like to raise their hand and ask for the group.
All right. Yeah, thanks for the presentation. When I first started, I always thought that I was battling like the markets, right? But what you've just gone through right now, it seems like really I'm battling myself. Is that right? Like basically I've got to develop the right mindset and understanding of what's going on inside my head with these
Yeah.
emotions that are going on. Because what you're saying is we're at a disadvantage with our default brain.
Yeah. Absolutely.
Like really, that's it. I mean, it doesn't really, I'm not going to say strategy doesn't matter or system doesn't matter, but the game changer here is like understanding what's going on inside our heads when those emotions are coming up and then saying, okay, is this legitimate or not? Like today, for example, I was in a trade and I was at a good point where I thought, okay, I could go short and it just didn't want to go short, right? And saying, okay, well, we're going to give it some time, give it some time. And I noticed a lot of frustrations coming up inside me. Like, I want this to go, I want this to go, and it's not going, and blah, blah, blah. Finally, the end of my session came at about 11. I thought, you know what, this is just not working. And I'm just going to throw in the towel and close the trade with a small loss. But that game is within my own head.
Absolutely. Yeah, absolutely. That really
ATS aside, right?
Yeah. There's a lot of aspects to the game because there's a technical aspect, obviously, but then there's the mental aspect. So I think the first thing to understand before you go down the technical rabbit hole, which there's so much there, the first thing to understand is understanding the basics of what we talked about here. Why is it so easy for me to take a loss? And why is it so dang hard to take a win, a consistent win? And it's starting to just be aware that I don't like feeling losses. Therefore, I want to close them. And when I see a big winning trade, I get complacent because I want to see how much further it's going to go. So the moment that you start looking at yourself kind of like here, you can think of it this way, like I'm here, I'm sitting at the screen, I'm kind of going through a default program. Okay? I'm running the pain program. I'm running the pleasure program. Well, that's what we are. By the time we're 35 years old plus, we're basically running on 95% pre-programmed conditioning. We've been working on our whole lives. We're not creating anything new unless we really work at it. So we're just running these programs in all areas of our life. So this is the one that we're running right now is when I feel pain, I want to make it stop. When I feel pleasure, I want to keep it going. The awareness that we need to develop to start with is to understand this is happening. So we need to be aware of what we're thinking. We need to be aware of what actions we're taking based on those emotions. So it kind of takes, you got to kind of step outside yourself and look at what programs am I running? And the moment you start observing yourself in the program is the moment that you're out of the program and you could do something about it. Most people never observe themselves from that point of view. They just run the program. So that it starts with that awareness. And then you also are going to develop awareness that everyone else around you in trading is operating with the same thing, conscious or not. So if you see a bunch of people have gotten into a trade at a certain level, and next thing you know, the price is above or below, opposite of what they did, you know that entire group of people is uncomfortable. And you know that you're not wondering if they're going to want to close out. You know they are. You know they're unconscious to this. So we are looking at the group as a whole. That's what we always want to take kind of this overview perspective of everything happening in the market. We have buyers, we have sellers, we have banks, we have market makers, all these people. Us at ATS, we're trying to rise above the entire thing to look at how everybody's playing. Where are people? Where have they bought? Where have they sold? Who's in pain right now? What are the banks likely doing? And we're trying to put it together like it's a big chessboard. We're trying to work all the different pieces and figure out what is it that I should be doing right now based on this giant overview. So again, going back to your question, it starts with understanding yourself. You are playing a game against yourself. It's becoming aware so that when it's not that we're not going to run the programs, not that we're not going to feel pain. It's not that we're not going to feel pleasure, but it's being aware hey, I feel pretty good right now. Maybe I should be looking to take decisive action instead of not. It's having that awareness all the time. But then the methodology side, what leads to the technical understanding of the market, is now applying that understanding to everyone else. Where are they feeling pain? Where are they feeling pleasure? What's the bank's tactics? How does the bank need to make money? They're trying to make money, a return on a big pile of money. They need to accumulate. How are they going to do that? How are people, where's the pain? That's where they're going to accumulate. All these little things you start putting together will result in a very well-rounded approach to the market. And that's essentially what we're doing here at ATS. When we talk about the basic strategy, the trading in the trend flow of money and then trading above or below value is in line with these things from a technical standpoint. Because fair market value is a balance point. When traders trade, they buy above value and they sell below because it's breakout trading. Most traders will favor confirmation over trade placement. So as they get the confirmation that the market is pushing, they join. When it goes against them, then they get out and then they reverse their position, go the other way. So everything we do here is already based on these mechanics, but it's good to understand it. And this is the point of this lesson, is to get you to your question, is to get you to understand how it works personally in you, and then how to apply it to the mass market. So I don't know. I kind of went off on a bunch of things, but does that kind of reemphasize what your question was?
Yeah, it validates it. Yeah, the battle's in our own mind, and developing the awareness so that we can work with it. I also guess that these feelings in the normal world, they help us, but within the trading environment, if we're not aware, they're a hindrance, right?
We need programs. We need pain and pleasure response. In the normal world, it's great. Going back to the hot stove analogy. If we didn't have any pain response, our hand would just melt to the pot. We wouldn't know anything. So these programs are wonderful. They're designed to protect us. We know when we're coming up to a red light, we automatically have a program that's like, what does red light mean? Red light means stop. Otherwise, I'm going to die and get, T-boned going through the intersection. Things like that. We have all kinds of ways that we set these things up to protect us. But in trading, it's really the opposite. These things are designed to work against us, or they do work against us. And so everything's flipped on its head. And it goes back to the story I told at the beginning of this thing, was it's really trading. If it's so unevenly weighted in trading, there's no greater example, I think, in the world of financial inequality. It's no more pure than the business of trading. So for someone to get into this business and not study right off the bat why people lose, is it a problem with the technical strategy? That's part of it. But really, what's at the root? What's at the root of a technical strategy is a belief. It's a belief. If someone believes they're going to win, they'll open the trade. They're not going to open the trade until they have that belief. But with that belief comes the discouragement of that belief. And the discouragement of that belief is what creates the actual predictable part of trading, which is the release of liquidity. So discouragement. We can't, even the banks don't know when the pleasure is going to end. When are people finally going to take profits? They don't know. The only thing you can count on is pain. That's when we know there's going to be a decisive action taken for someone to click the button, which is what they're interested in, because they need the liquidity to do what they do. So they are highly, highly incentivized to push that market just a little bit past that stop point. That's why they'll get into trading. They'll be like, it's like the market almost knows exactly where my stop is. That's why you start feeling like you start getting very personal about it. It's like it's purely out to get me alone. It's because of that. When you feel that way, it's because you are running the programs and you're falling victim to the pain and pleasure thing. It's up to us to stay above that. And again, the way that we stay above that, small position sizing, staying out of localized framework, giving the market room to do its thing, and looking at it from a perspective of how is the bank accumulating? Where are the highs and lows they're going to use for this? When I see that, first, that's when I initiate. I'm not getting in the market and then waiting. That's why we like to trade off liquidity lines, because we get information there. Institutional levels as well, more recently. We get information at these because they're breaking points. And those clues that we get at those points are really what allow us to not only reinforce our current trading plan, but also make decisions if we need to change or whatever. We're always trading from the story that's happening as it's unfolding. We're way above everyone else. That's the ultimate perspective. If you think about it too, a bank they have to kind of run their business. They're totally dependent on liquidity to be able to make a return on their pile of money. And they can't just absorb it all at once. They have to hide what they do. They actually have a very hard job. Okay? Like, they have to do things undercover. They have to do manipulation. They have to do weird things. They have to put out news stories that are false or misleading. They got to do all kinds of different things to make money. Okay? Us, if we're simply aware of pain and pleasure theory, we understand how liquidity is manufactured, we understand how the bank does business, it's really the ultimate place to be in. It's the best place because we don't have the restraints of liquidity. As an independent trader, you can, if just trying to make a living yourself, there's always liquidity for you. It's not like you got to have this time delayed scale in, scale out plan. You're just in. The only thing you guys got to do is be aware and sit above it all. That's your entire job. So really, you guys have the best place in the market is to not only have the knowledge of how this works, but to not have any of the restrictions or the difficulties that the banks have to actually do it. It's the best place. So you combine that with prop funding, things like that, the long-term perspective, you guys will be good.